All right, so now we're going to look at our active investment. So here we are going to buy some Annie's common stock. We're going to buy 40,000 shares. There's 100,000 shares outstanding. The total stockholders' equity was valued at $5 million. So what percentage ownership are we going to have? You can do that pretty quick. Division, 40,000 divided by 100,000 is 40%. This means we're going to have to use the equity method because we are falling in that range between 20 and 50. What is the initial entry? Oh, man. These are the questions everybody wants for the exam. Initial measurement, always easy, right? So this is going to be my investment in Annie. It makes my assets go up. Cash go down. We paid $2 million, so that is what I reported. That's the fair value of 40% of that company. It's $2 million. See, 40% of $5 million would be $2 million, and that's what we paid. So there we go. All right, so now we're going to look at some subsequent measurement. Now with the equity method investments, we talk about the fact that those equity method idea, if you flip back to that handout, we're going to have to keep track of dividends. We treat them as a return of capital, and we're going to keep track of our share of the investees' income or losses. All right, so let's just go through these questions will kind of lead us there. From last class, meaning the last slide, what percentage did we own? We own 40%. Okay, how much in dividends did we receive from this investment? Well, there's a $2 per share dividend. We own 40,000 shares. So that pretty basic math is going to give us 80,000 in dividends. Okay, that's $2 times 40,000 shares. Oh my goodness. That's supposed to be a 40,000 shares. Gave us 80,000. All right, so number 3 says for active investment, dividends are considered a return of capital. True. Record the dividends you received. All right, so we got cash, right? They paid us dividends. We got cash. We got cash of 80,000. We just calculated. The return of capital means that rather than recognizing this as revenue, it's going to be basically a payback, a return of what we paid out. So it's going to make our investment smaller. It's like money back, okay? It's like we're getting our money back, part of that investment that we made. So that's not really revenue, right? That's just a return of that's what return of capital means. You're just getting some of your money back. All right, so that's what our entry looks like to record the dividends. Is this the same as the entry we made in activity 3? No. I'm going to leave it to you to remember what the difference is. Okay, that is not what we recorded in that last activity for the passive equity investment. That dividend payment did not look like this one. All right, what is our share, JRM share of Annie's net income? So there was net income of $600,000. We own 40% of the company. So our share is based on that percentage. So that is going to give us $240,000. As our share of their net income. Okay, $240,000. So now an active investor shares proportionally in net income or losses. So what that means is we get to record. Our financial statements get the benefit if they make money or absorb the loss if they lose money based on our percentage ownership. So here, when that Annie makes money, it makes our investment grow because we own 40% of it. So if it grows, we grow. Okay, so there's our debit, $240,000. The other side of this is we get the benefit of recognizing our share of their net income. So this is investment income or investment revenue. That goes on our income statement in the other income section. Equity method investment income. All right, and so finally number 6 down here says, what is the ending balance in the investment in Annie? So I'm going to draw a T account to do that piece. All right, we had our initial, our initial investment was $2 million. We got dividends of $80,000 and a credit. That made our investment smaller. We get to record our share of the net income. Okay, that made our investment bigger. Those are the only two things that happened, as they usually would be. And so then we're going to have $2,160,000 as our ending balance. So that would be the answer to number 6, $2,160,000. Now we talked in class, I took this opportunity to show you something that will help you remember how the equity method works. And that is this idea that you already knew when you came into class. That's how retained earnings works. So we talked about this just for a minute. If you, at the beginning of the semester, if I ask you, here's your retained earnings T account, there's the beginning balance, what makes retained earnings bigger, you would have said, oh, I know, net income makes it bigger. All right, well, what made our investment in Annie bigger? Net income. Okay, if it had been a net loss, it would have made it smaller, right? That would make net retained earnings smaller. At the same time, it would also make investment Annie smaller if it was a loss. If I said to you, what makes retained earnings smaller, you would say dividends, right? You'd say dividends make it smaller. If you look at our investment in Annie, what makes it smaller? Dividends. Okay, so my point here is for you to recognize that with the equity method, we basically are keeping track of our share of this company that we have significant influence over, our share of retained earnings. All right, so that's our share of their retained earnings. So you see we have the beginning balance, net income makes it bigger, dividends makes it smaller, and so we get our ending balance the same way that retained earnings works. So there is that. So we had a couple of questions about that equity method investment. And I think that might have been the end. Okay, so that is the end. Oh, I did have this good look ahead question. Thinking ahead. We're going to do some change in our method of accounting eventually.